So now I want to sort of take a very quick run through the economy at different levels. So we're going to start with the United States. I'll probably spend the least amount of time here because we've just heard so much important information about the state of the macro economy. We're then going to dive into California. And then lastly, we'll spend most of our time, as we usually do, on Ventura County. So when it comes to the United States economy, obviously, this has been an incredibly challenging year for economic forecasters. Some of you have been in this room, you've seen this political cartoon before. This is one of my very favorite political cartoons related to international trade. But international trade has caused very large behavioral responses in the economy. As you're going to see, shifting the timing of economic activity. And it has meant a very, very, very difficult forecasting environment. Now, in terms of what that looks like, the thing that we forecast, the bread and butter of a forecasting house, and the thing that Dan and Bill won, second most accurate in the United States for in 2016, is for forecasting quarterly, annualized, real GDP growth. This is inflation adjusted. It's how much the economy grew since last quarter, so over the last 3 months. And then we do this crazy thing where we say, now let's pretend that the economy continues growing at the rate it has for the last 3 months for 9 more months. We do this weird exercise. We say, okay, how much did we grow since last quarter? Now let's assume that persists for an entire year. What do you get? And so we introduce this crazy volatility into the data that doesn't actually exist there. Right? The economy doesn't grow or shrink at the exact same rate for any 12-month period. And so this is this highly volatile data set. We're forecasting this, and you start to see things like, well, did Dan and Matthew forecast a negative 0.6% GDP in the first quarter of 2020? No, we didn't. You were here a year ago. You know I didn't forecast, we didn't forecast a contraction of the economy in the first quarter. We were forecasting positive growth in every quarter. Right? And then did we also forecast this massive explosion, apparent explosion? 4% growth for 2 quarters after that, and then this dramatic slowdown? No, we didn't forecast it. And by the way, is this really what real economic activity looked like in the United States last year? Was there a giant contraction of economic activity in the first quarter followed by this surge in economic growth? Well, the answer is no. In fact, this is really the product, this apparent volatility is the product of how we measure economic activity, when we measure economic activity, and then the fact that we do this crazy thing where we annualize the data and assume that whatever's happening today persists for an entire year. And so, as we've looked at this, Dan and I really believe strongly, and this is a legacy we take from Bill, is that we need to spend as much time looking at our forecast errors, looking back and figuring out why were we wrong. By the way, as a forecaster, you're wrong every single quarter. You are never right. The only question is which direction. Were you too high or too low, and how big is the gap? So we spend a huge amount of time studying our forecast errors. And there's a tendency when you look at this data to think, whoa, this is chaos. How do you make sense of this? And so you often feel like this, all right? We're not even hitting the targets. Well, as I mentioned, some of that's just a function of how this is measured. And so I want to share this with you. One of the ways Dan and I have, first of all, so this year, in response to the uncertain environment, we've decided we're going to stick to fundamentals. We're going to stick to economic theory, what we know about international trade, what we know about monetary policy and inflation, which you've heard a huge amount about in the last 3 years if you've been at these events. We're going to stick to those fundamentals, and also we need to think creatively about how we're actually measuring economic activity. And so this is a simple adjustment here, where instead of looking quarter on quarter annualized, we just look at the half years. There wasn't a giant decline in economic activity in the first quarter. What actually happened was that Trump announced the Liberation Day tariffs, and everybody who was going to import something rushed it through a U.S. port before April 1st and Liberation Day to beat the tariffs. And so what's interesting in accounting, growth accounting, is that we subtract imports from GDP. If you rush a bunch of imports into the ports, you're going to subtract the dollar value of all that from GDP. Economic activity can, over a longer period of time, can remain fairly stable, but because of the timing of when we measure it and how we measure it, you record these big numbers. If you actually look just averaging over those first 2 quarters, so averaging over -6 and 3.8, you actually see that it was just modest growth in the first half and modest growth in the second half. And when you look at these two numbers, and you look back at what we forecasted a year ago, you actually see that we were very, very, very accurate. In fact, we only missed the last year's GDP growth by 10 basis points, 0.1%. Right, so you heard us forecast, I think it was 2.2, and it came in at 2.1 for the year. And so we forecasted 2.1, it came in at 2.2. And so this sort of validates this idea that we're going to keep sticking to fundamentals, and we are, calling balls and strikes and not obsessing too much about any single quarterly number. So you saw this a year ago. What are the fundamentals when it comes to international trade? Well, we know that tariffs cause net job losses. Different studies by the Federal Reserve Bank, Columbia University, and Princeton, that's 3 different studies documenting job losses. In fact, the 2018 Trump steel tariffs did cause 5,000 net new jobs by steel producers, but it caused 26,000 job losses among the people who use steel as an input, so net job losses. We also know that tariffs increase the price of both imported and domestic goods. You heard me talk about this last year, that Trump's 2018 washing machine tariff actually increased imports and domestically made by exactly the same amount. If your competitor raises their price, you'd be crazy not to raise yours to just 1 cent less than theirs. And so we know this, these are fundamentals. There's some new research that I wasn't aware, that actually hadn't been published yet, so we couldn't talk about this last year. But we also now, it's well documented that tariffs also slow economic growth, and in fact can do so. One of the primary channels is through business investment. Business companies sit on the sideline and wait to learn about how the political environment's going to unfold, what the policy will be tomorrow. And that decline in growth can actually offset price increases. In fact, one of these two studies actually says the net effect of increasing prices on both domestic and imported goods immediately at the beginning can then be more than offset by the decline in economic growth and the decline in demand. And that actually the total effect can be negative. And so again, this is insights. These are insights from economic research and economic theory that we continue to employ as we try and make sense of this environment. We did have we were fans of this, the Supreme Court setting aside the current tariff regime. Of course, by the next day, we had learned there was going to be a 15% across-the-board tariff under Section 122. If that comes to pass, that would actually raise the effective average tariff rate across the United States today. So that's not good for economic growth. But a famous trade economist, Scott Lincecum, said, that wasn't the end of the story there last week. This is actually only the end of the beginning of the trade war. So stay tuned. We'll have much more to talk about a year from now as this continues to evolve. One more thing I want to talk about before we jump to California in terms of our sticking to fundamentals is that we're still very attuned to monetary policy. If you've been in this room the last 3 years, you have heard lots and lots and lots about our views on monetary policy. And I just want to add that we still hold that monetary policy is not tight. This is not a restrictive monetary policy environment. The call for cuts to interest rates is highly inflationary. And I would just hold up this fundamental, that actually the money supply, the amount of money in circulation, has been growing every single month since October of 2023. And in fact, the growth rate of money, if you just think about more dollars chasing the same amount of goods and services, the price of everything will go up. That rate of money supply growth is actually consistent with 3% inflation. And so we're not at all surprised that in the last 3 months, the PCE measure of inflation went from 2.7 to 2.8 to 2.9. It accelerated the last 3 months. We're still watching this very closely, and we continue to think that monetary policy is easy. It will be very interesting to see if the new Federal Reserve Chair actually follows through on some of the things he's been talking about and writing about for the last few years. In this room, you've heard us talk a lot about the Fed's balance sheet, the trillions of dollars of assets they hold. He's talked about the imperative of shrinking that balance sheet, and we wish him Godspeed as he attempts to implement policy of that kind. So last year's forecast, this is what we said: positive economic growth slowing to an anemic level. We were forecasting inflation well above 2% target. In fact, Our 1 year ahead forecast of inflation was 3%. It came in at 2.9. And in this case, believe it or not, the forecast is very similar. Positive economic growth, slowing to an anemic level, actually, but a higher economic level than we earlier forecasted, and it will take longer to slow. Our 1 year ahead forecast is 2.9% inflation. And then you might ask, well, hey, there's been an upward revision to your forecast from a year ago, and there has been, right? In fact, what you'll see is that our forecast for 2026, if you look in the publication, is actually quite a bit stronger than a year ago. And one of the things we've really been surprised by is the rapid surge in equipment and intellectual property investment. That's AI investment. And that has actually lifted, in the short term, the growth prospect for this next year. So that is a slight upward revision. What all this looks like here is you see, obviously, the long-term average pre-Great Recession growth rate for the United States. The sweet spot of economic growth is about 3.5%. That's growth that produces rising wages, upper economic mobility. You see here that in 2024, we had 2.8%. We were down to 2.2% in 2025, and we're forecasting 2.2% for 2026. That is an upward revision from last year's forecast for 2026 as a result of AI. And so that's the outlook. So there's, again, work to be done, as you've just heard, a lot of work to be done in this sphere, but we are forecasting positive growth for the entire forecast horizon. So now let's jump into California. What's going on in California? Right? If you've been to this event before, I know you want to see the number, the summary statistic of all summary statistics. The U-Haul index, believe it or not, so I actually give between 40 and 50 public talks about economic issues a year. I get more requests for the U-Haul index than for our quarterly GDP forecast, our work on environmental markets, any of it, all right? And so if you haven't been to this event before, what the heck is the U-Haul index? Well, the truth is that what we've been tracking as a leading indicator of economic activity for a number of years is net migration. This is one of the best predictors of future economic activity. Every year, people are leaving California for somewhere else. They're in the United States. They're coming to California from somewhere else in the United States. And the question is, what's the net result of that? Are more people moving out to seek opportunity? Or is this a place where they see greater opportunity, they're moving in? And this net flow, which has been negative every year since 2001, is a very good indicator, forward-looking indicator of economic activity. And actually, you do see that net migration, the net out migration, has slowed since 2021. And obviously, the COVID-19 pandemic and some of the state responses did drive an outflow of people. So we've been tracking this for years. But at CERF, we also think, goodness, these are just numbers. What is 216,000 net domestic migration, negative 216,000? What does that mean? We're trying to look for ways to bring life to the data, to make it more understandable, accessible, also to sort of talk about the fact that these are human beings that are making these decisions that are representing the data. And so what we came up with in 2020 was the U-Haul index, where we just started tracking prices. Markets are very good aggregators of information. Prices contain a lot of information. And so I was preparing for a presentation in the San Fernando Valley. We looked at the rate from San Francisco to Las Vegas. At that time, they wanted $1,200 for a 10-foot truck. Can you believe that? $1,200 in 2020. And this is January. This is before we knew about the COVID-19 pandemic. But net migration out was strong. To look at that exact same truck on the way back in, it was only $94. $2,400, $94. Okay? They almost paid you to drive a truck back. And so we thought, wow, this is really interesting. And we can actually, markets and price signals are very important. We can use this to actually study which direction the net flow, is it accelerating or decelerating? And so we looked at, well, what's that ratio of outbound prices to inbound prices, and how is it changing over time? And you can see it actually accelerated with the onset of the pandemic. And then the craziest thing happened. In November 2021, U-Haul ran out of trucks, outbound trucks. They had none. There was no amount of money. The price went to infinity. And that's where the index almost broke down. And then you do see, actually, if you were here a year ago, we reported that the U-Haul index had actually dropped below January 2020 levels for the first time since we had been recording this data. And that's a good sign. That means net out migration is slowing, okay? So the U-Haul index, the question is, what's the number now? So we were getting ready for this event, and 5 weeks ago, on a dark day in January, I open up the Wall Street Journal, and you won't believe what I saw. Now, these U-Haul people, I'm not an intellectual property attorney, but I think they're violating some common law trademark that I've developed, all right? This is crazy. So what are they doing? Well, they're actually just tracking the number of trucks. How many trucks left, how many trucks came in. And this is a pretty good measure. Without a lot of data and analysis, you can see, well, which states are more trucks leaving from? Those are the blue states here. Which states are the destinations? And those are the orange states here. Okay, and so I thought, oh, pretty interesting. Maybe there's room for improvement. We can innovate and extend this to price information, not just the number of trucks. And we can actually study what are the top destinations for California folks. So I just started playing around, and you can see here Los Angeles to Salt Lake City, $1,250. Los Angeles to Las Vegas, $330. We can obviously look at the return. What's the difference in price on the return? Okay, and what you see here is Las Vegas, $330 out, $129 in. That's a multiple of 2.56. There must be a slightly stronger net flow to Salt Lake City, 1,250 on the way out, 482 on the way back. Actually, the difference, that statistical difference, the 0.56 and the 0.59, might just be the Fienup family, because we did move our son to Salt Lake City in August. So we're part of that problem. Actually, we didn't take a U-Haul. Never mind. I started looking, what are the biggest multiples? Idaho Falls and Pocatello, a little farther up the 15 freeway. The ratio jumps to 4.19 and 4.2. So our new and improved U-Haul index, look, the net flow of people to those destinations is even stronger than Salt Lake City and Las Vegas. So my question for you is, and Rick McLennan's not allowed to answer this question, what is the number one destination? Where is this inbound, outbound multiple the largest? Where are more people going? Where's the demand for outbound trucks even higher than inbound trucks? Where in the western United States? Coeur d'Alene, Idaho, 5.42, more than double the index of Salt Lake City and Las Vegas. So anyway, so this is what U-Haul, these U-Haul people using their U-Haul registered trademark to start an index. This is what they've made us do. So we're innovating, we're trying to follow in their footsteps. All right, so in terms of the forecast, again, the forecast is actually, you can see here, we have seen a slowdown in the net out-migration of folks from California from the COVID peak. We expect that to hold steady. We don't expect a dramatic worsening of that. And so I guess that's a modestly good prediction. You can see our forecast of economic growth for California is that we anticipate positive growth at a higher rate than the United States for the entire forecast horizon. That should always be, given California's natural endowment of natural resources, given the amazing weather, given the extraordinary legacy, creative legacy of Silicon Valley and Hollywood, California should grow more rapidly than the United States, and we do see that, although only modestly stronger for the entire forecast horizon. There is room for improvement here. Obviously, that gap should be substantially higher. This is below potential growth for California. I'll also add it's below potential growth for the United States as well. But now we've got this new thing. So one thing I want to just finish with in California, you may have heard about this new exodus, right? The exodus of billionaires who left the state in December after the announcement of the billionaires tax that's going to be on the ballot in November. So this is an amazing opportunity, I think, right, to innovate in the economic measurement space. So the billionaires tax is driving billionaires out. So what we're going to do is we're announcing for the very first time the Net Jets Index. So what this is we're going to look at one-way private jet rentals, okay, from Los Angeles to Phoenix, Los Angeles, and we're going to look at the price. And by the way, if we see that $1,200, $94 U-Haul thing with private jets, like you could fly commercial to Miami and rent a private jet to bring it back, right? You could plan your family vacations around this if that price differential is big, okay? So stay tuned next year for the inaugural Net Jets Index, all right? So that's California.